Good morning from London. I'm Kriti Gupta alongside Johnson and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. No tariff impact yet. U.S. inflation accelerating to its fastest pace since the start of the year, but goods data easing those concerns that trade-related costs could broaden out. Meanwhile, investors continue to price in interest rate cuts, sending stocks to a record high. Treasury Secretary Scott Bessent still pushing for 50, though. And Ukraine's president says he won't cede the eastern region of Donbas to Russia as the U.S. and Russian leaders prepare to meet on Friday. Trump is due to consult European leaders this afternoon. Val.
Let's take a look at how these markets are faring an hour ahead of the opening trade here in Europe. We are seeing S&P Futures treading water, even though they did close at an all-time record high yesterday after that soft CPI report. Euro Stoxx 50 Futures outperforming this morning. They did underperform yesterday. Maybe that's a bit of an explanation. Euro-dollar holding on to the gains of yesterday. We saw the dollar slip after the new BLS appointee talked to Fox News about potentially pausing the NFP report. U.S. 10-year yield holding steady, 1 basis point lower at 4.27. The countdown to the opening trade starts right now.
Wednesday the 13th, good morning, welcome to the show. What would actually happen if the Fed came out in September and cut 50 basis points? How would the markets react? How would the various markets react? I think people are going to have to start kind of conjuring with those sort of ideas because yesterday's CPI report apparently was very dovish and basically brings up the idea of a 50 basis point cut, despite the fact actually that services inflation picked up, which kind of wasn't that expected, and goods inflation didn't, but apparently goods inflation is coming. Did it feel that dovish to you, Val?
Well, look, there was a lot going under the hood. I know you just mentioned it, their pickup in services inflation, but what the market really focused on is that there was a minimal tariff impact when it comes to certain components that we had our eye on. Things like apparel, furniture, audio equipment all showed deflation in the month of July, which is very much playing into the hands of the doves. This idea that tariff is a one-off price impact, that it won't cause persistent inflation. And essentially, this print yesterday was not hot enough in any way to take the Fed's eye off the weakening labor market, and that's why we saw such a jubilant market reaction in the equity market. But could possibly have been one of the most boring CPI outcomes in some ways. There's really no surprises here for the Fed to be worried about.
We talked about this 24 hours ago. We said one possibility that we're not talking about at all is the fact that there is no tariff read-through at all at the end of the day. That being said, I think it's interesting because there was a lot of commentary around where you are actually seeing the pain, and that is ultimately in things like housing, the energy costs really coming down, really offsetting some of the places that were actually ticking up. How long does that last if energy prices are as volatile given the geopolitics?
This was a hot print.
In your mind?
Services inflation. Sure. Services inflation. The bit that shouldn't be tariff affected is where it shouldn't be.
Yeah, but you can point that was one-off factors and things like used cars and health care. It always is, yes. But the thing that we were most concerned about, and the reason that's caused such big upgrades to CPI, has been the tariff-induced inflation. And we're continuing not to see the big impact that we've been expecting. We even saw J.P. Morgan yesterday revise down their tariff pass-through calculations. We had Fed members yesterday, Schmid saying tariffs seem to be having a limited impact on inflation, and Barkin also saying to the Wall Street Journal that inflation will be more moderate than people think.
Do you think Jan Hatzius agrees with that?
Let's go to that conversation. That's a different thing. I mean, look, Jan Hatzius is probably having a little bit of traumatic PTSD, perhaps, in terms of the market reaction, or sorry, in terms of the White House reaction as well. I think it's important to keep in mind, though, is to your point, it is a hot print in the minds of the markets right now. They are pricing, or excuse me, it's a cold print in the minds of the markets right now, in that they are now pricing in more cuts at the end of the day. But to your point, there isn't really a case for it. And you saw it in the commentary from economists across the world. So is that a dislocation when it comes to the stock market?
Is this political pressure? So does the market believe that political pressure is now having a bigger effect than data pressure? Is the data pressure significant enough to justify 50 basis points? Is the data pressure significant enough when added to the political pressure Is this political pressure that is driving 50 basis points? You've got Bessent out talking about 50 basis points.
This is the market narrative of tariffs don't matter, and I'm not worried about them showing up in CPI. Because, look, you saw volatility really collapse across asset. You have the VIX at year-to-date lows. You have FX volatility at lows. Fixed income volatility really got smacked yesterday. So this is a repricing of worries about tariff-induced inflation. And that is what we saw yesterday. It drove the equity market to all-time highs. World global stocks are at all-time highs off the back of it.
If the Fed cuts into all-time highs, what does that what kind of a world is that, where the Fed is cutting into a stock market that's all-time highs?
It's a world where the labor market is loosening and disinflation is still broadly on track to get back to 2%.
But it tells you that the stock market is not the economy, right?
Well, the stock market is the AI trade. I know we've talked about that many times.
Hold on a second. I don't think it is just the AI. It is mostly driven by the AI trade, for sure. But you look at the other corporate earnings, you look at the margin pressure, you look at the feed-through costs, and it is still able to digest a lot of this. You see it show up, maybe no tariff impact on the consumer, but you see it show up in PPI data. You're potentially seeing it in PCE data later this month as well. There are places it's showing up.
You take the AI trade out, the multiples that you should be getting on this market would be significantly lower. That's where the story is at the moment. So the AI trade has been the monster that has driven this story forward. Sure. And you do wonder what a kind of, if you throw gasoline on that fire with this kind of trade that's on at the moment of lower rates, how do they react to that?
But you also have to think about the other parts of the economy, which are in some ways being a bit more punished by higher rates. Look at housing. That's not been doing well. The Fed's been talking about that. Other more rate-sensitive parts of the economy are being hurt. So, maybe you could argue that the Fed should set one rate for AI and the rest for the remaining bit of the economy.
It can't. So is there a danger that you end up with a melt-up, or if we haven't already had one at all? That you end up with, this is the question I'm asking. Asked at the beginning. What happens if you get a 50 basis point cut? The stock market goes to the moon. Like, it's already at the moon. It passed the moon and is on its way to Mars. It's kind of, where are we in this narrative of how far can the stock market go if you start seeding it with rate cuts?
Everything you just said there makes me more bullish. So
No, I agree. There's a reason to be super bullish with this. It's just I'm wondering how the Fed is thinking about this. Well, because the Fed does the market need the Fed to deliver on that? And if it doesn't, what's the reciprocal side of that? The other side of that trade?
It feels like and I think the point you're trying to make, and this has been something that's been in the ether for some time, is that if you don't actually have those rate cuts materialize, do you see some sort of correction by year end or going into next year as well? This is something I'm sure that will come up with our interview with U.S. Treasury Secretary Scott Bessent. He joins Surveillance later today at about 12:30 p.m. UK time. The team over there, I'm sure, will pose all these questions to him.
There's a meeting coming up a little bit later on. Let's talk about geopolitics and how that's going to impact potentially Europe today. You've got a leaders' meeting that is taking place between the European Zelensky and Trump. This is obviously in advance of the Friday meeting in Alaska. The Europeans, I think, have got a massive problem here. You've got this situation where the Russians are demanding the Donbas region. If you bring up the map, you can kind of see the slice that they're acquiring as quid pro quo for a ceasefire or a peace deal. And the Europeans are sitting there looking at that slice of the map and going, ultimately, we may have to ultimately monitor this, and we're going to find ourselves in a situation where, go back in history, salami tactics, you take a slice at a time and you work your way across. And that's going to be the fear that I think the Europeans have, that they essentially are allowing Russia a slice of territory that they can build behind and then launch the next attack. The Ukrainians, obviously, that'll be their fear as well. Right. But I don't know how much traction the Europeans are going to get today in their conversation with Trump. It feels like he is on a different page to the Europeans in wanting this deal to get done. I don't know where expectations currently sit at the moment, but certainly that is the fear that resides in Europe. But can Europe actually gain traction with Trump to persuade him that that would be a mistake? You listen to what the Vice President said, it's basically your problem.
Yeah.
Over to you.
Yeah, so it seems like it's all coming down to territory, with the big, risk that Trump promises Russia some Ukrainian territory without Ukraine being at the table, without any security guarantees or any of the likes given to Europe. But
that's what Europe would have to provide.
Exactly.
And so basically the people that are going to have to deal with this situation are not those that are going to be ultimately at the meeting in Alaska.
The White House calling it a listening exercise when it comes to this meeting. We've gone from a potential ceasefire agreement to a listening exercise.
We have those every day here at the table, don't we?
We certainly just did on the Fed that point as well. But the point that Vladimir Zelenskiy was making on the cessation of territories ultimately is that if you do have the Donbas region, which has largely and culturally and ethnically related more to Russia, and even kind of polls with the idea, and has been a long kind of going idea that ultimately it should be part of Russia. Again, a local poll, not a international one. There's a question of where does it stop? And this is the same conversation on the foreign policy front we were having with the Crimea conversation over in 2014. So we'll see if there's even a dent made when it comes to this conversation with Donald Trump, because you made the point yesterday that maybe these talks aren't just about Ukraine. It's ultimately United States and Russian relations, given the context there have now been nuclear submarines, nuclear powers, nuclear missiles that have been threatened.
They want to take Ukraine. I suspect Putin wants to take Ukraine out of that relationship. Regardless, this is a win for him. He's going to America. He's been invited to America. Puts him on a different stage than he's been on for a very, very long time. Anyway, we will see that meeting and how it transpires a little bit later on with European leaders and Donald Trump a little bit later on. I think the Vice President's going to be joining from the Cotswolds as well, enjoying his holiday. Not really a holiday, but anyway. Let's talk about a working holiday. I don't understand that concept. Bernier Kong's going to be joining us from UBS Econo very shortly, CIO of Multi-Strategy Alpha. We'll get his take on what we saw yesterday, record highs, what's happening with the German curve as well, of significant interest to him too. Fabrice Pothier, Rasmussen Global CEO, joining us a little bit later to talk geopolitics. Marina Zavalok, Morgan Stanley's Chief European Equity Strategist, is going to be joining us. We saw a massive hit yesterday to European tech. Where does that leave us as well? E.ON earnings are out. Leon Birnbaum is the CEO of that business. Where is he going to invest? How much is he going to invest in the German grid system is going to be interesting as well. And Vegard Wollan, Nordic Semiconductor CEO. What does Nordic Semi do? It makes Bluetooth devices. This is a communications company. It produces chips that communicate with each other. What is happening there with the tariff narrative? There's lots to discuss on that front too.
Let's take a look at what data we get coming out today. There isn't a huge amount of data, but we do have a few reports to keep an eye on. One of which is at noon. We do get MBA mortgage applications out of the U.S. We have oil inventories later in the day, and then we have the Bank of Canada minutes at 6:30 p.m. Later, we do get a big round of Fed speak. We have three Fed speakers on the docket. Very much an interest there on whether they think yesterday's CPI print was hot or cold. Hopefully we'll get some new insights from Fed thinking later today.
Absolutely. Looking forward to all of that coming up a little bit later on. What else do you need to know this Wednesday morning? According to the Financial Times, the US Vice President, J.D. Vance, is planning to meet with Reform UK leader Nigel Farage a little later on today. He's got a busy schedule. Farage will meet the Vice President as his party leads UK polls, building on his long-standing relationship, of course, with the US President Donald Trump. Vance also met with Shadow Justice Secretary Robert Jenrick this week, which is interesting. Badenoch apparently not on the list. A European rocket, critical to the continent's goal of reducing its reliance on Elon Musk's SpaceX, has launched successfully. The Ariane 6, which had its debut in July 2024 and is the centerpiece of Europe's space ambitions, lifted off from French Guiana yesterday. The rocket deployed an Airbus-made satellite into polar orbit for weather forecasting and climate monitoring. AI startup Perplexity has submitted a bid to acquire Google's Chrome browser for $34.5 billion. The audacious offer comes as Google faces US antitrust proceedings that could require it to sell the web browser and license search data to its competitors. One analyst said the offer vastly undervalues the asset.
Coming up on the program, U.S. LNG exporter Venture Global has won an arbitration over Shell, ending a 2-year legal battle. We'll check on Shell shares at the open. Plus, Donald Trump is set to talk to EU leaders ahead of his meeting with the Russian president. We're going to preview what's at stake and whether or not they can make a dent. But up next, right back to the markets, the U.S. CPI print is out. The Fed rate bets are in. We're going to dive into whether this all makes sense. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg.
What we see is that inflation creeping over and spilling over from goods into services. And that is an issue for the consumer in terms of, is the consumer now starting to make tougher choices because of the impact of tariffs?
It appears that companies have room as a result of still high margins coming out of the pandemic. Companies have room to sort of more slowly pass this on to consumers.
People say, oh, the retailer's going to eat it. No, they're not. They just wrote the check. So of course it looks like they're eating it. Walmart writes a check, but eventually they're going to pass it on.
It comes one way or the other. It's either going to be corporate margins, which all else equal is a drag on the stock market, or it's going to be in the consumer, which is a drag on the economy, which then feeds through to the stock market.
Lots going on in terms of the stock market. How much of the CPI print changes the narrative? Val is all over the story. Val, walk us through it.
Hey, look, yesterday's CPI really put to bed the extreme worries over tariff-induced inflation, at least for now. And we saw volatility decline across assets. The VIX closing at year-to-date lows below the 15 handle. We also saw a collapse in volatility in FX, even in front-end rate vol also falling. So this is really, I guess, given the heads up to this equity market rally, this decline in implied vol will definitely help that out. What else will help it out is the continued pricing in of these Fed cuts. Yesterday basically solidified that 25 basis point rate cut for September. But we had Scott Bessent trying to move the goalposts even further, talking about how the Fed should consider going 50 in September. In his mind, they should have already been cutting if they had seen those payroll revisions before. We have seen some pricing and some options trades targeting a 50 basis point rate reduction in September. But in my mind, I think we're going to pause around this 25 basis point price in because we still have a lot of risk events on the horizon before the Fed convenes again. We have Jackson Hole. We also have another round of inflation and labor market data before we get that decision. Guy.
Long way still to go. 50's on the table, which makes 25 easier to digest, maybe. That's the narrative we should be maybe thinking about here. Bernie Okong, CIO, Global Multi-Asset Strategist Alpha leader over at UBS, CIO for that. Good morning. Nice to see you.
Yeah, great
hey,
to see you.
Look, you sat down, you're like, this is a hard take to fight right now. The positivity that is exuding from the other side of the table is definitely manifest in many areas of the market. Val just pointing out, you've got a 14 on the VIX. You've got a stock market at a record high. How hard is it to keep things going? What do you see here? Is it a market that you want to hate but have to be part of? Is it a market that you love and have to be part of? I'm just kind of wondering how you're thinking about the narrative at the moment in your mind, and your kind of the way you're investing right now. Is it defensively? Is it aggressively? Is this a market that we should all be as positive as the numbers suggest are?
Yeah, no, look, it is really hard to fight. And I guess to answer the question, I'd say very short-term tactically, we have been a little bit more cautious around some of the growth data. But, you're seeing the market reaction. And the fact of the matter is the bull case is buying into 26, which is very hard to argue against, which is, you're going to have fiscal expansionary policy in the US, you're going to have fiscal expansionary policy in Germany, and you're going to have a whole bunch of Fed rate cuts. And you can't disprove that right now. And you can't say this, things are getting ahead of themselves, because that is quite a significant change. So I think people are on buy the dip, watch. And whenever you get data which actually isn't as bad as feared, we have that sort of, rally and chase. Are
you comfortable with multiples as they are right now?
It's a struggle, but I would say you are only. You know why? Because the things that are driving the market, they aren't things where you're really worrying about next year's multiple. They're things where the growth is accelerating so much that it's actually about your multiple 3 years out, 4 years out, which I know sounds very far and crazy, but because of the exponential growth we're seeing, that's what the market's doing. So I don't think, put another way, the market is being irrational. Do I see a lot of potential risks to dent some of the sentiment and expectations? I do, but the market's not being irrational at this point in time. We could go much further before the market gets irrational.
Well, talk to us a little bit about what is the straw that breaks the camel's back here. What turns this market around?
So I think, look, on the CPI and Fed debate that you're having, I guess I lean on the side of 5 rate cuts seems a lot to price in for me, based upon a few things. One is Powell went out of his way to tell us that basically he doesn't care about the payroll revisions because he's focused on the unemployment rate. And so as long as the unemployment rate stays low, that's not going to really change his thinking in terms of softness of the labor market. Two is the payroll data that was revised was a backward-looking point in time, and actually some of the more recent data points suggest actually things aren't that bad. Three, the underlying inflation rate you're getting coming through right now, and we know that there's more tariffs to come, is basically above 3%. So cutting five cuts would take you to 3%. That's like basically leaves no leeway for error whatsoever. So I think whilst we are going to see rate cuts from here, I don't think that there's a backdrop where unless we have a big slowdown in growth, you're going to get that extent that the market's pricing in.
You mentioned it's hard to fight the tape right now. How expensive is it to be bearish?
It's very expensive, and I think what's particularly difficult for, sort of more experienced PMs like myself is normally you've had historically some reversion in some of these relative trends. Even if you have things which keep outperforming, you get some pullback, you get some temporary setback. We haven't had that. I mean, it's been a tape where I think when I look back and see some of the recent moves, it's just been relentless and very unusual actually in my career to see kind of no even 1 week, multi-day pullbacks in some of these relative trends.
Bernie, I want to get your thoughts more here on Europe. I read your piece about curve flattening. Yesterday, we had quite a decent steepening in European curves. The German yield hit the highest since 2011, the 30-year yield. What's your reasoning for why you think German curves should flatten? Yeah, so it's definitely a relative call. It's absolute, but it's particularly relative versus the U.S. And I think the driver for it is if you look at ECB and now obviously Bank of England policy as well, they're basically signaling that on the short end, rate cuts from here are going to be very hard to come by. And we've seen that they're not going to move in lockstep with the Fed because actually they've already been cutting rates. And the data in terms of what they're seeing and suggesting doesn't justify continue to progress with that. Equally, we don't have the same long-term growth, bullish inflation forces of the U.S., so I don't think the long end of the curve can really move in the same way, and we don't have the same deficit sustainability concerns, which is the other factor which also is moving the long end of the U.S. curve as well. Yeah. Do you think that there is a risk that those debt sustainability fears do come back, at least in the Treasury market? Because that was something that definitely dented the equity market rally when we did have those kind of blow-ups in long-end Treasury yields. Is that something on your horizon that maybe you're worried could come back? Yes, but I think it will require that growth slowdown because the numbers are basically such that people will be comfortable with that deficit as long as growth looks great in the U.S., but then it's such a double whammy of sensitivity where as soon as growth slows down, suddenly that deficit blows out, right, in terms of what you're projecting forward. So I think we will need to see some sort of sustained multi-month period of growth slowdown for people to be worried about that again. How much further can the equity market go? You said we could go a long way from here. Are we in the foothills of this rally? I don't think we're in the foothills of the rally. I would say if you just think about, so I'll take it in a few ways. So from a valuation standpoint, if you put some of the higher growth areas of the market on these sort of, more lofty multiples I talk about in terms of 3-4 years out and then discount back, you probably could get to an S&P which is, 7,500 and above, something like that. Right. Something around that level. So that doesn't, that distance to where we are now shows you it's not like we're at the start of that, journey. The other thing is then you start to think about, positioning, sentiment, how retail behaving, amount of leverage in the financial system doesn't, again, suggest to me we're at the early foothills of this. But as I said, we can go on with this story of believing in these 26 bull points for a number of months. And at this stage, given the setup, I would suggest, probably it won't be until we get closer to the actual delivery and execution of that will we really find out whether there's something to be justified or not. Bernie, I have a million more markets questions to ask you, but I think our audience really wants to know your sandwich recommendation. Tell us. Less sandwiches, more bone marrow risotto. I went to a place on the weekend, Town in Covent Garden. So if you're going for a theatre visit, highly recommended. Opened a few months ago. It's kind of British food. They do this bread. You can dip it with its juicy gravy. They do a cherry clafouti. It's amazing. Really recommended. Town. Okay. Town. Simple name. Yeah. All right. Bernie Kong, CIO, Global Multi-Strategy Alpha at UBS O'Connor, with a side of restaurant recommendations. We thank you so much. Coming up, we're going to dive into the geopolitical risk, of course, over the next 3 days. Ukraine's President Vladimir Zelenskiy and some EU leaders planning to talk to President Trump today ahead of his meeting with Vladimir Putin in Anchorage, Alaska on Friday. We're going to dive into the details next. Stick with us. This is Bloomberg.
30 minutes to the opening trade. How are we feeling this morning? Let's take a look at futures and figure out exactly how the market is looking at the world at the moment. And as you can see, it's a little bit more positive. Again, just another incremental climb higher. You could argue that yesterday's session, some of that was already priced in. There's a little bit maybe more to price in out of the United States. But yeah, more incremental gains. European equities continue to rally. Not in the same degree that we saw yesterday, maybe out of the United States. But we have a tech problem here. Look at SAP and look at how those stocks traded yesterday.
Let's take a look at the European fixed income open. We are seeing yields drift slightly lower on this Wednesday morning. Germany 10-year yield is 1 basis point lower. This does come after quite a steep sell-off yesterday. They really, I guess, the price action, at least in Europe, was very much different from treasuries yesterday. We saw German 10-year yields rising, 30-year yields after rose 8 basis points yesterday, hitting the highest since 2011. So that was one key thing for the European markets yesterday.
I mean, it feels like we're in a little bit of a holding pattern. Some of it's more data that we're going to get throughout the rest of the week, but it's also a massive geopolitical risk that we are watching. And this question of whether or not some sort of resolution on Friday or lack thereof actually changes the dynamic when it comes to how you trade Europe. Let's dive into the details of that. Vladimir Zelenskiy is rejecting Vladimir Putin's demand that Ukraine give up the Donbas region to secure a ceasefire. Now, the Ukrainian president says the Donbas could be a bridgehead for a future new Russian offensive. This as some EU leaders and Zelenskiy talked to President Trump today ahead of his meeting with Putin in Alaska on Friday. Joining us now for a little bit more context here, Fabrice Potier, CEO of Rasmussen Global. Fabrice, a pleasure to have you on the program. Thank you so much for joining us. Walk us through what we could get out of the phone call today. There's a big question here that with European leaders and Vladimir Zelenskiy excluded from the talks on Friday, European leaders don't have a ton of say at the table. Would you agree with that?
Definitely, we are witnessing a high wire act here, diplomatic act by the European leaders and the Ukrainian president, trying to basically invite themselves to this bilateral summit in Alaska by conveying to Trump and Vance, I guess, some key red lines for both the Ukrainians but also the Europeans. Territorial integrity is one, but I think it's also about the kind of guarantees and the kind of long-term future that the West, especially the Europeans, can provide to Ukraine. So I think it's about trying to redefine the equation of a possible deal where Ukraine can come out on a better side.
Fabrice, what is perhaps the scariest scenario when it comes to the conversation or the result between the United States and Russia? We've been having a big conversation around the table about whether or not Ukraine should even be a part of the conversation when it comes to U.S. and Russia, or is that something the White House thinks about? What is the doomsday scenario here for Europe?
I think we need to be honest here, and it's already a diplomatic win for President Putin to be invited to the U.S. territory to meet his American counterpart. It's a way, I would say, a way to get out of his international isolation from the top. So this is already a diplomatic win. The question whether he's going to turn that into a long-term win for himself in Ukraine. And President Putin has been very open in the sense that he says he still pursues the same goals he had from the start, which is to basically dominate and control Ukraine, both in a military way and possibly non-military way. So concretely, in terms of bad outcome, you could see potentially a kind of recognition of the military fait accompli, of the fact that you are military power occupying your neighbor's territory, and just because of that, you will be given, under international law, at least American recognition, control of this territory. That's one thing. The second thing, which is not military but political, which will be to try to, in a way, topple President Zelenskiy by possibly forcing some elections in Ukraine. There is an alignment between Moscow and the MAGA movement on the fact that Ukraine and its president will not be legitimate, we need elections. And obviously this is a very toxic narrative, especially coming from a country like Russia, which is an autocratic country.
If all that happens, if a deal is done and some of what you described comes to pass, what happens to European defence spending?
I think actually European defense spending are going to stay on that trajectory for the simple fact that if Russia gets its way in Ukraine, there will de facto basically be a even closer threat to the NATO border. And if Russia stalls and is, in a way, diplomatically pushed back, it is clear that Vladimir Putin, it's about reloading the gun. It's not about laying down the guns. So he will keep his war machine, and he might even want to commit it to other aggression or attacks. So I think in both scenarios that we're contemplating right now, Europe needs to keep on spending more and better to be able to deter Vladimir Putin and defend itself.
So the picture you're painting is basically of an escalating threat, not a de-escalating threat.
Absolutely, because a solution in Ukraine doesn't mean you have a solution with an aggressive Russia. On the contrary, they will be able to reallocate the resources, which are now almost close to 1 million Russian soldiers are directly or indirectly committed to the Ukrainian operation, to be potentially recommitted to other flanks and other points that are connecting both Russia and the broader NATO territory.
Fabrice, we're just talking about escalation there. There is the Wall Street Journal reporting just in the last few minutes that Russian military has made a surprise push into eastern Ukraine in recent days. Does this tell us anything about how Putin is trying to position himself before these talks in Alaska on Friday?
We are witnessing the typical Putin playbook before high-wire negotiation, where he keeps on asserting his military leverage on the situation on the ground to buy himself as much diplomatic leverage as possible. We have seen that every turn of every negotiation. This is not to diminish the importance or not of this tactical gain. It's just to put it into a broader context. It is also clear that the Russian forces are having huge losses. It's almost 3 soldiers for 1 Ukrainian soldier. There were counts of something like 1,000 Russian soldiers dying or being injured every day over the past few months. So Russia also has a depleting Russian force on the ground. So they are making a push to make a point, but I don't think we can talk about a dramatic collapse of the front line.
Fabrice, is it possible for you to put a number on for us? I mean, we're market participants here on just what the likelihood of any positive breakthrough for peace on Friday is?
I mean, I don't want to mislead the markets and investors, but I think what is clear is you will have a bilateral meeting, which actually has been yesterday, I understand, reframed by the White House as more a listening meeting. I think they're lowering expectations. It might lead, in the best case scenario, into a framework agreement, very broad but not very specific. And the specifics will be left to trilateral efforts between Russia, Ukraine and the Europeans, possibly with President Erdogan as a facilitator. And this is where it gets really difficult and, quite frankly, uncertain. So I think the best scenario we might contemplate might be a reduction of hostilities with a greater role by diplomacy, but not the end of the war, because this is a long effort by Vladimir Putin. He started in 2014, and he's known to be a very persistent actor.
All right, Fabrice Potier, CEO of Rasmussen Global, we thank you so much for walking us through some of the dynamics at play. Coming up on the program, Venture Global triumphs over Shell in an LNG arbitration case over the sale of cargoes from its first export plant. We'll talk about that and your other stocks to watch next. This is Bloomberg.
"17 minutes to the opening trade here in Europe. What are we talking about in terms of futures? Just picking up the pace a little bit. Look at that. We're starting to gain a little bit more traction in terms of the numbers we're seeing on the screen. It looks like the German market, which had a tough day yesterday with some of these software stocks, maybe bouncing back a little bit more this morning, up by 0.4%. All of this potentially on the back of that inflation print that we saw out of the United States yesterday. The CPI story absolutely front and centre. And Kriti, keeping an eye on what is happening here.
We are. I mean, look, it's really interesting. This data print, I think, what we were preparing 24 hours ago in the lead up to it was supposed to be hot. We were supposed to be seeing a tariff read through. We were supposed to be seeing more. And we didn't to the same, perhaps, expectation of the markets, expectation to economists around the world. There are two components of that I really want to zero in on. And one of that is housing and shelter, because if you look at the breakdown, and at least yesterday's data print, shelter actually increased. That contributed to the core coming in a little bit hotter. But I think the trend is really important here, because if you look at a 5-year chart of those shelter prices and owner's equivalent rent, you can see we had that massive increase in 2022. A lot of that was the catch-up post-COVID. But it has come down pretty significantly. And you're seeing that in buying housing as well. In terms of second-tier cities, you have seen those prices actually come down. So when it comes to affecting the end consumer, there is an argument out there that even if you do start to see the tariff read-through show up in more of those goods prices, perhaps housing coming down could offset some of that. We didn't see that in yesterday's print, but this is the broader trend that we've seen. Another piece of this is going to be energy costs as well, because John Authers in his column over at Bloomberg Opinion made a really crucial point that if you take the CPI number and pull out energy of it, it doesn't look like it's really changed all that much. It feels fairly stable. It's still kind of on a downward trajectory. So I thought I'd bring up the AAA gas prices over in the United States. Basically, the prices at the pump, $3.14 is where we're at. But you can see this range that we're looking at here really since the start of April. Some of that having to do with that spike over at Liberation Day. You did see that move. The geopolitical risk has been baked in there, but largely kind of staying in line. If you see energy prices come down a little bit, whether it's due to oversupply, whether it's due to concerns about an economic slowdown, that's yet another factor, Guy, that could actually offset some of those tariff increases, at least when it comes to the nominal data set.
Tariffs? Why do we need to worry about tariffs? Tariffs aren't having an effect. Nothing to see here. Move on. Thank you very much indeed. Kriti, great stuff. Thank you. Let's talk to our Markets Live executive editor about all of this, Mark Cudmore. Mark, tariffs, why do I need to worry about them? They're not having much of an effect. Nothing to see in the inflation numbers. Nothing to see really in terms of the NFIB number as well.
Good morning, Guy. I know you're being slightly flippant, but it is actually the right attitude to have right now. The NFIB returned the kind of results that at the moment it seems that the fiscal tailwind is dominating the fact of tariff concerns. And that is very different from 6 months ago. And that was a real positive data point that certainly I myself missed until only a couple of hours ago because we were all so focused on the CPI print. And I think that's kind of a story we've talked about the last couple of months that, you know, if you'd asked me back in February, I thought that we're going to be trading the tariff story aggressively and negatively by sometime maybe around May. We didn't know the exact month, but we thought that was the kind of timing, and we thought it was a binary timing issue. One of the things that we learned is with the stop-start tariff process and the amount of uncertainty around it is that it's not going to be a binary timing point. It's going to be kind of slowly drawn out. And companies, second of all, this is maybe the second point B, companies are going to delay reacting to tariffs so long as possible. Because of all the kind of changes of policy so far, it is not advantageous to react quickly and then find they didn't need to. So at all levels, people are going to delay. And the third point is they've been able to front run these tariffs. So therefore, businesses have more room to delay. So tariffs really are a slow moving story. We're starting to see the impact, but they're not a major negative yet and may not be a major negative until fourth quarter at least. In fact, I wrote a piece saying fourth quarter recently, and people said it may even be first quarter when we see that impact, though everyone agreed it will ultimately be an impact and a negative one on the US consumer and the US economy. But right now, tariffs don't matter. We've got a tailwind on the fiscal side, and we had an inline inflation print. We've got the scary catalysts out of the way, so stocks are booming in the short term.
Scary catalyst out of the way. I think the VIX is reflecting that also. It's at year-to-date lows on the VIX. We saw a big drop in vol yesterday across assets. Do you think all of that is warranted given yesterday's inflation print?
If you'd given me the full set of news flow yesterday, including the CPI print, including that the budget deficit would widen unexpectedly, including that we'd quash hopes of an imminent US-China deal, we'd quash hopes of an imminent Russia-Ukraine truce, it seemed like such a negative news flow. I wouldn't have predicted the euphoria we're seeing in global stocks. So I spent the morning kind of casting around, what did I miss? The NFIB survey that Guy pointed out was one of those things. I think the collapse, though, in vol is really, really deeply relevant. And maybe I was underestimating the impact of that. We're not expecting a negative catalyst for a while. Given what we've seen from AI so far, NVIDIA earnings are unlikely to derail us. Jackson Hole is unlikely to derail us because Powell is being undermined. He no longer can sway policy as easily. So we don't really have any scary catalysts on the horizon until September. And I should say for Russia-US peace talks about Ukraine, the expectations are already so low, so that really can't be a negative surprise either. So I think that we're probably waiting until September data now to have a real macro turning point, at least from the scheduled events. So you're either just waiting for stocks to run out of steam, or essentially the collapse in vol means this is a positive tailwind for markets.
Certainly feels like that at the moment. Mark, great stuff. Thank you very much indeed. Bloomberg Markets Live Executive Editor Mark Cardmore. You can catch Mark's views, the rest of the team's views, MLIV Go on your Bloomberg terminal. Let's talk about the day that Europe had yesterday and maybe some of the differences that stand out. Take a look at what happened with European tech yesterday. SAP got dinged by nearly 7% yesterday. Bloomberg Tech Europe anchor Tom McKenzie joins us now to tell us why. Why?
Yeah, this was an almost 16 billion euro market cap hit to Europe's largest company by market cap. This is around the AI is eating software theme, and it was picked up on the back of a session in the US where the software incumbents there, the likes of Adobe, the likes of Salesforce, the likes of Monday.com, all got badly hit. Europe woke up, saw the moves lower in terms of some of those US names, Adobe amongst the mix as well, and thought, OK, we're going to lean into this theme around the risks that companies, startups like Figma, like Canva, like Pigment here in Europe are starting increasingly to take market share from these incumbents. That was what led to the downside pressure in these software companies. It's worth pointing out that SAP, for example, in its most recent update, said that it's shipping about 50% of its cloud deals involve AI. So they are integrating, they would make the case, in terms of their AI innovations. They have their own AI chatbot, Joule, for example, that they say their customers are keen on using. But it's a question as well, and it's a reminder that unless you're leading on AI innovation and integrating and shipping and getting revenues, then there's going to be scrutiny in terms of how vulnerable you are to some of these startups.
When talking about some of that read-through, though, there was also a question, at least in the German index yesterday, about kind of this defense undermine that continued. Is there a relationship between the defense story and the tech story when it comes to the way Europe trades that? The
defense story and the tech story. Well, interestingly, when I spoke to the CEO of SAP a few weeks ago, he talked about the fact that they may see an uptick in terms of their demand from some of the defense contractors. The fiscal spend comes through in 2026. Defense contractors start to feel the benefits of that. Then they'll need additional software to layer onto their products to ensure that those defense capabilities are properly integrated. So maybe that's part of the story there as well. And on the defense piece, of course, you have the startups trying to challenge on that front, the likes of Helsing, which is a German-based company in terms of producing drones and defence software to take on the likes of Palantir. So the two are certainly linked. It's also worth noting that we had the hardware piece of this. You can't have the software unless you have the hardware channel, and you have the CoreWeave story coming in focus yesterday as well. A strong beat in the second quarter, but question marks about margins and about the cost of building out these data centres.
Well, talk to us about data center stocks. How are they reacting to this?
Well, this could be a reader-through from CoreWeave. So the stock, for the context, the stock of CoreWeave has tripled since its IPO in March. And this is a company that basically builds the data centres on which OpenAI and Microsoft, two of their key customers, are reliant. They came through a really solid beat, so earnings actually tripled in the second quarter. They raised their forecasts for the year, but it was the losses that came in much higher, almost 40% higher than the estimates, that seemed to cause a concern. And again, in the context of the stock that's tripled, so a 10% downside that we saw yesterday for CoreWeave, run by Michael Intrata.
Which stocks in Europe are most exposed to that? So if yesterday's narrative was pricing in some of the risks out of the United States into names like S&P, where's the risk in Europe this morning off that CoreWeave story?
It's hard to see an equivalent CoreWeave in equivalent builder of data centres in Europe. You have the component makers that go into that, so the chip makers. So Schneider Electric, exactly, that provides some of the energy systems and the cooling systems around these data centres. So look at Schneider and maybe look at some of the makers, some of the chips that go into these data centres. It's not the AI accelerators, but those chips that accompany and go into the racks, so the likes of Infineon.
All right, Tom McKenzie, the next edition of Bloomberg Tech Europe with Tom airs this week. He'll be exploring how AI is changing the way we work. That coming up at 6:30 a.m. London time, a week from Friday. Lots going on in the tech space. Let's get our stocks to watch with Chloe Melly. Chloe.
Good morning, Kriti. Let's start with gaming today. So we might see a bit of weakness in Evolution after executives were secretly filmed discussing how games made their way into countries illegally. So we're talking about countries like China, Sudan, Iran, so where gambling is either illegal or countries under US sanctions. Evolution has already been underperforming its peer Lottomatica by a large margin. And just to give a little bit of a sense of scale of this story, Evolution sells a lot of its games in unregulated market compared to a peer like Playtech, for example, where 90% of revenue was from regulated markets. Moving on to a completely different space, the hearing loss space. So Demand cut its guidance for the second time this year last night. And so we might see a bit of weakness. The stock is already down 4% year to date. So we might see a bit of weakness there. And it might also be dragging a little bit of the shares of its closest peer, which is GN Store Nord. So let's keep an eye on that today. And then finally, Shell. Let's keep an eye also on Shell today. It lost its arbitration case against Venture Global, which is one of the largest exporters of liquefied natural gas. We might see a bit of weakness there, even though Shell has been outperforming by quite a bit. And it's also really important to keep an eye on this particular dispute because it might have consequences for LNG contracts around the world.
Thanks for equities reporter Chloe Mele running us through some stocks to watch at the open, which is just 7 minutes away. Another stock on our radar is Vestas. There has been some big losers in the wind energy segment with Ørsted a few days ago, but Vestas seems to be doing okay.
Bounce back yesterday. Talks about some orders that have been made in the States, but the States is the area of vulnerability and or instability, I should probably argue, when it comes to that, the wind turbine story. Looks like the market is taking the numbers today okay-ish. There's a Q2 margin story, which may end up being a little bit disappointing. That certainly seems to be the narrative that is emerging early in terms of the numbers. Full year still sees full year revenue at 18 to 20 billion. The market's kind of right in the middle of that, so it's sticking to guidance for the full year, which is interesting. But the margin story, which has bedeviled it in the past, has been one area that the market has kept a firm eye on, and that could be the area that we're going to see potentially some weakness coming through this morning. We're going to talk to the CEO tomorrow. Henrik's going to be joining us. We'll look forward to that conversation. We'll get his take on what is happening stateside, his relationship with Donald Trump and the White House, a firm focus there. The European Open is about to happen. Keep an eye on tech. It was the story yesterday. It may be the story again today. Keep an eye on Vestas. Keep an eye on Shell as well this morning. Plenty of stocks in focus. 5 minutes to go until the Open. This is Bloomberg. Wednesday morning, good morning. We inch higher. Stocks look like they're going to push a little bit more firmly to the upside this morning at the get-go. We'll get Val to do the futures in just a second. This is the session yesterday. This is from the start of US trading yesterday, just to give you a little bit of context in terms of what we're seeing. We saw a reasonably choppy session before this, but we rallied into the close in Europe, and the US markets continue to rally as well, on the back of the idea that tariffs don't matter, that the Fed's going to cut 50, that all is good, and that inflation is not a factor. The Fed, all clear. Time to cut. That's certainly the message coming from Scott Bessent at the moment. Anyway, US equities like that. We need to price a bit of that still into the European story this morning, Val.
Yeah, the strong Wall Street close is really tempting these European stocks heading higher this morning. At least the futures picture is broadly positive. We're nearly 0.3 higher on the Euro Stoxx 50 futures. FTSE 100, 0.2% higher, and DAX futures up 0.3%, falling on from this record high close, this record high trading for global stocks. Kriti, what kind of stocks are we keeping an eye on at the open?
Well, the tech story, of course, drove that record over in the States, and it's that ripple effect that we're keeping an eye on right here in Europe. Data center stocks, of course, at the center of it to avoid the echo there. Of course, CoreWeave is very much an American story. We're just talking to our very own Tom McKenzie, but what kind of read-through you would get into Europe. But it is certainly one that we want to watch, especially those companies that are claiming to make those big investments. SAP is one great example of that AI trade. It got beaten up pretty good yesterday. Maybe we see a little bit of a rebound today. And, of course, as Guy was mentioning, Vestas is very much in focus. They came out with their earnings today. There's a Donald Trump component to the offshore wind story as well. When we speak to the CEO tomorrow. Nevertheless, we'll see how those shares react at the open, Guy.
Okay, here we go. Time for the Wednesday session. What are we going to see delivered by European equities first thing this morning? A few surprises yesterday. Let's see what we get today. We're expecting a positive story at the open, and here it is. Time for the European trade to get underway. FTSE 100 absolutely flat as a pancake. We're going to watch that one quite carefully. There's an interesting Shell story that we're going to be needing to integrate into that market. There's a few earnings as well. Some of the house builders are out with figures as well today. That may be trickling down into the 250. Stock 600 up by, let's call it 0.1%. FTSE gaining a little bit of traction. Maybe we'll see the stock 600 tick higher. The IBEX is up by 0.4% at the moment. Let's see what happens with the DAX. Beaten up with the tech sector yesterday. SAP's been a massive driver of that market, along with the defence names recently. Does that continue today? What happens after we saw that beaten up yesterday? Do you buy the dip in European tech after yesterday's news? The CAC 40 is up by 0.3%. We'll give the DAX just a moment to get itself going. What are we seeing in the sector story? Val, over to you.
Some of them are flat, some of them are green. Currently, we don't have any in the red. We have 11 sectors in the green. At the top of the basket is construction. We also have technology performing pretty well, so it doesn't seem like they're picking up from those negative CoreWeave results yesterday out of the U.S., so tech is trading decently okay. I want to also highlight that energy, while the sector itself is trading little change, we are seeing a big move lower when it comes to Vestas. Okay, I say big, it's down 2%, but at least big for how the market is opening up this morning. But sector focus looking pretty decent.
Looking pretty decent. I have to say the ones that are standing out to me, at least this morning when it comes to both the Stoxx 600 and the FTSE 100, is that healthcare is right back in the driver's seat. I'm looking at Novo Nordisk, AstraZeneca, Sanofi, Roche, Novartis. A lot of the fears from the last couple of weeks in terms of the drug pricing, in terms of the tariff risk, seems to be reversing today. But maybe that's all that it is. Maybe it is simply, Guy, just a reversal from the beating they've taken.
Defence has come back a little bit over the last couple of days. Took a bit of a beating over the back end of last week into the beginning of this week. We're starting to see some of that maybe coming back a little bit, which is interesting as well. Some of the retailers are on the front foot in Germany by the looks of things. Not seeing that kind of tech trade coming back. SAP at the moment, I've yet to see SAP open. I've yet to see Rheinmetall open. Some of the autos are not open as well. I want to see where SAP trades after being dinged up, as you say, yesterday in the session. We don't have those numbers at the moment. Looks like the auto sector in the DAX is going to be lower. So we're waiting to see exactly what the DAX does, but it looks like it's taking a while to get SAP open this morning, which I think is, I don't know, could be quite interesting. It's not necessarily the positive sign that you would have hoped for after the stock got beaten up as badly as it did yesterday, and we still don't have a trade. It's taking a while to get the DAX open, and SAP looks like the reason for it. Are we out of the woods yet on that narrative?
Have a little more faith in the Germans. They still have 15 seconds for the index to open up. Maybe we see a little bit more reaction there.
All right, well, we can think about the next catalyst potentially for European stocks, which is maybe more on a geopolitical front with Russia and U.S. meeting in Alaska on Friday. We just got some news crossing the tape that Zelenskiy will have a bilateral meeting with Germany's Merz today. So a lot of this narrative continuing, and I want to bring this question to our guest sitting around the table, Marina Zabolak, the Chief European Equity Strategist at Morgan Stanley. What kind of catalyst could we get from geopolitics into European equities?
Yeah, I mean, I can't predict what will happen with the conclusion of these talks, but I think if we think about expectations into the talks, we have had some sectors move. The earlier in the year, when there was a lot of anticipation of these peace talks and a lot more kind of priced in for this, it was especially a couple of themes that captured investors' imaginations. It was the idea that Ukraine could be rebuilt if there's any peace deal, and the idea that gas prices in Europe could go down if Russian gas flows resume to Europe. Obviously, you would need a lasting, more than a ceasefire, a lasting peace deal for those things to happen, and it's highly complex. We don't think it's easy, but if the talks go well, let's say in that scenario between the U.S. and Russia, and then let's say then the U.S. and Ukraine, then you could see those pockets of the market, like construction stocks on the rebuild story, for example, chemicals on the lower gas, those could move. We've already started to see them move a little bit. And to the point you were just making, defense has sold off in anticipation. I think that's a really great buy the dip opportunity.
Buy the dip in defense. Excellent. Okay, so these valuations on defense, many people are still saying that they're still quite stretched. When it comes to further catalysts for defense, it would come from this infrastructure spending being maybe spent a bit quicker than expected coming out of Germany that would help boost defense stocks further.
Yeah.
What else are the positive catalysts you have an eye on?
I think when people look at valuations in defense, there's a very big misperception out there because it's mostly generalists kind of looking at defense these days that hadn't looked at them for many years. And you're looking at valuations on a 2% of GDP defense spend number because analysts cannot put 3% into their models until they know exactly what that money is going to be spent on. So when we get the German budget, for example, in September, when we start to get the projects details coming out, then you're going to see analysts run that through their models and very significant earnings upgrades in the defense sector, and then valuations will come down. Suddenly it will look more reasonable. I think also whether or not these talks go well on Friday, Europe still needs to rearm. So there's been a bit of a sentiment dip on the back of the talks, but that in my opinion, is a buy the dip opportunity, and that will pass.
Well, speaking of buy the dip, Marina, just as you were speaking on the defense piece, I want to take a quick moment and highlight what we're seeing in the tech space as well. SAP shares have officially opened higher by about 2%. We'll see if it recovers the almost 7% loss from yesterday. But as I was looking at some of these numbers, I realized that SAP trades at about circa 235 euros in terms of the share price. Apple shares trade at about $230. So I'm going to take the conversion out for a second. They're trading around the same level for an everyday investor who wants one share. When you think about tech, from a European versus American perspective, how do you think about asset allocation from that point of view? These are both the mega weights or the heavyweights in their respective indexes. If we're talking about the end of American exceptionalism or perhaps a bigger push into Europe, do you think about tech?
Yeah, I mean, Europe tends to get left behind from investors thinking about tech. You know, people usually think about that for China and for the US. I think about tech in Europe as highly, highly idiosyncratic, first of all. So as far as enablers of AI, you have pockets of that, and we especially like software, more so than semis. So we're overweight software, we're overweight business services, which has some adopter enablers as well, kind of software driven. We're underweight semis. So that is, we think semis in Europe are a lot more cyclical than the semis you have in the US that tend to be more AI driven. But I think the tech story that probably doesn't get enough attention in Europe is on just overall adoption, because we have about, on our calculation, 70% of the index are AI adopters, most of them pretty moderate or high adoption, and the low-hanging fruit in Europe from productivity improvement potential from our demographic challenges is significant.
When you talk about again, the bid into tech here, one of the big hurdles and detriments or bear cases for American tech is their exposure to the geopolitics, their exposure to other international markets, namely China.
Yeah.
Because Europe is still developing its tech sector, because Europe is perhaps a little bit more insulated, does that actually make them a better bet when it comes to tech because of that more domestic focus?
No, I wouldn't say necessarily. I mean, parts of the European tech sector are highly China exposed as well. So semis, for example, that's one of the reasons that we're underweight the sector, is very high China exposure. Software is a bit more resilient in that regard, so that's correct.
What's the argument for buying European equities at the moment over US equities?
I think you don't.
Okay.
I mean,
so does the gap widen out? The last 3 months, Europe has underperformed quite significantly.
Yeah, I mean, we made a call in March
Yep.
that Europe had peaked
Yep.
versus the US tactically.
Yep.
At the time, people thought I was crazy because that was kind of the peak of euphoria around,
Yep.
you know, fiscal spend
Yep.
and all of that. I think we're maybe a third of the way of giving back that outperformance that we had earlier this year. There's a very nice indicator that we track, which is the kind of like-for-like discount of Europe versus the US. So sector neutral, take out Mag 7 because we don't have anything like that.
Yeah.
And that discount tends to, it's been widening, but it's been widening in a range over 10 years. And when you get to the bottom of that range, it means Europe can outperform the US. That happened last December. When you get to the top, that means Europe euphoria relative to the US has gone too far. That happened in March.
Yep.
We're now 1/3 of the way down. We're kind of like rolling down the hill.
Does it always revert down to the bottom before?
Yeah, I mean, not in a straight line, but yeah,
Okay.
it reverts down to the bottom. We're 1/3 of the way rolling down that hill. And I think the big story is, number one, we don't have as many AI enablers, and AI enablers are driving the earnings growth in the US more so than anything. FX is having a really big issue. So when you look in local currency terms, we have 0 earnings growth. The US has 10%. Very hard to motivate people to buy Europe with those, you know, those optics.
Is there if you're worried about the market going too far in the States, does Europe offer safety? I appreciate that we're probably going to revert back down. I'm curious to know how quickly that would happen as well.
Yeah.
Do you buy on the way down, weirdly, in terms of in terms of a risk management? option?
I think you buy pockets of Europe. We really like the banks. As I mentioned, it's a really great time to get into defense because of this dip that we've just had on sentiment rather than fundamentals. So there's definitely, in software, there's been a dip as well. I don't think that's justified. So you get into pockets, but then you have a lot of very cyclical, low pricing power, China exposed sectors in Europe that are going to continue to struggle. So that includes the likes of luxury, semis, metals and mining, even energy. We have quite a lot of cyclicals in our index.
Yeah.
Marina, we just had a viewer IBS about a question that they want to pose to you about how intertwined U.S. tech is with this European defense story. So the infrastructure spending, the defense spending happening in Europe, is that something that the U.S. tech companies can capture?
Oh, I mean, that's an interesting question. I would say not yet, but maybe down the line in like 2-3 years' time. I think at this stage, Europe needs to focus on kind of restocking, it's rearming in kind of basic terms. But there is a very significant question about the longer term innovation driver, let's say, from defense spending, because if you look at other examples of where defense spending has ramped up around the world, it tends to be tied together with innovation. But I would think, as with rearming and just equipment purchases, Europe will increasingly want to do a higher proportion of that, rearming and innovation in-house in Europe.
In terms of, if the US goes to the moon, what is the gravitational effect on, if US equity markets go to the moon, what is the gravitational effect on Europe? Even though it's cyclical, even kind of what is the ripple across into global markets? It's not even
No, it's positive. No.
Right.
If the U.S. goes to the moon, it is positive for global markets. And let's not forget that Europe's exposure to the U.S. is a quarter of revenues. So we do have exposure to the U.S. as well, so we benefit from that. So it does have a positive gravitational pull. It's just that Europe doesn't underperforms on the way up.
Yeah, the gap widens. Marina, great to see you. Thanks so much indeed for stopping by to see us. Marina Zavalok, Chief European Equity Strategist, joining us from Morgan Stanley. Let's take a quick look at the core six this morning. We're expecting maybe some core weave effect into names like Schneider Electric. You're seeing a little bit of that. In fact, you could argue you're seeing some of that because you do have a significant underperformance of Schneider versus other areas of the market. Interesting to see chips maybe doing better than maybe some of the data center stories that we are watching on the back of that core weave narrative. Novo's up, LVMH is up. You're generally seeing a bid across the markets. It's interesting that SAP has come back, but it's still not completely come back after the losses that we saw yesterday. We're just talking a lot about defence. Let's carry on that conversation. Chloe Mellie's here with the details.
Good morning, Gary. Yeah, let's start with defence. So we've got a wall of green this morning in defence. Rheinmetall, Hensoldt and Leonardo are all up this morning by a little bit. Not a massive jump, but we are up 2.5% for Leonardo, the biggest gainer there. This is the same story that we saw yesterday with Donald Trump casting doubt on the ability to kind of, agree with Putin on Ukraine. Moving on to SAP. SAP is coming back. This is a reversal of those software stocks getting hit from this AI threat. So we have SAP up a little bit, about 2% this morning. Moving on to Evolution. Evolution is taking quite a bit of beating this morning, down almost 7%. This is because the executives were secretly filmed discussing the entering banned markets and having games distributed in banned markets like Sudan, Iran and China. So it is getting a little bit hit today on the back of that. And then finally, Beazley. Beazley is an insurer, specialty insurer, and it's also down this morning, 5.5%. It cut its guidance this morning. It said that the long-term fundamentals for insurance were there, but until then, the market was quite soft. So it is down this morning on the back of that.
All right, Chloe Mellie from our equities team walking us through some of those early movers. We thank you so much. Coming up on the program, we're going to bring you a conversation with one of the CEOs. We'll talk to Leonard Birnbaum, the CEO of German power grid operator E.ON, about the company's earnings report. That coming up next. This is Bloomberg. Welcome back to the opening trade. About 18 minutes into today's session, green on the screen across the board. The DAX rebounding just a little bit after taking a beating yesterday, both on the defense front and the technology front. This morning, it is your outperformer, but I'm going to say not by much compared to yesterday's trade down, or excuse me, higher by about 0.7% this morning.
Let's talk about one big German stock that is out with details this morning. The utility giant E.ON out of Germany, warning that the country risks falling behind on its shift to cleaner energy amid counterproductive regulations and what it calls, quote, vague political pledges. The warnings come as the company reported first half adjusted earnings before interest and tax. They were up 14%. The operating line looks pretty good at 3.82. The EBITDA line about 2% ahead of consensus. The company's CEO is Leo Birnbaum, and he joins us now. Leo, thanks very much indeed for your time this morning. Always appreciate speaking to you. These are decent numbers, and the market certainly sees them ahead of consensus. We're all waiting for the big investment decision that you're going to be making. You're telling us that that's going to come at the beginning of next year. Kind of feels like you're waiting for the politicians to make some decisions. What do you need to see to be able to deliver the kind of investment that Germany needs right now in its infrastructure?
Yeah, we are actually waiting for two decisions that have to be made. One, on the political side, what is it that we really need for an energy transition which is not only sustainable but also cost efficient? And we expect that after the summer, after the review by the German government on the ongoing course of the energy transition, they have started a monitoring process. So that's the one side. So what do we really need? What do we want? On the other side, we see that no matter what politics decide, the need for infrastructure is unbroken and the trend is clearly upward. And here we need to see a better regulation so that after 2028, the current regulatory period is until 2028. So in the years 29 following, we can significantly increase our investments. And that requires a different regulation. So we're waiting for politics to decide on the course. But irrespective of that, for us, the growth story is unbroken. So we are now waiting for the final determination of the future regulation, which then tells us how much we can invest. But it is important to say that until 2028, the growth case is basically unbroken.
Okay. If you could answer both of those two questions now, and I'm sure you've kind of got an idea of what you think the answer to those questions look like. How much do you think you need to invest? Give us a hint of the scale of the kind of investment that we're talking about here. Your investors are trying to figure out. They're trying to extrapolate forward. They're trying to get an idea of what you are thinking about what those numbers look like. Give me a ballpark kind of figure. What does it look like? I don't want you to jump the gun here, but you must have a number in mind.
Yeah, but I don't want to give you now a precise number because that obviously would be a guidance to the market, which we can only give based on the regulation. What I can tell you is that over the last 4 years, we have doubled our overall investments. We've actually, and if we look at the projections of Eurelectric, our industry association, or the BDW, the German association, we understand that we need to double or triple infrastructure investments versus the historic position for at least 2 decades. So we have a massive growth opportunity in front of us. Now, we as E.ON, we are now on a run rate of 43 billion in our rolling investments planning. We assume that this is going to go up, but if we look at the demand drivers, everything is pointing towards higher demand. Data centers, battery factories, e-mobility, e-transport, everything requires even higher investments than we are currently seeing right now. So the question is, can we finance those higher investments? And that depends on regulation, and this is why we are so adamant on this point this morning.
Leo, hi, it's Valerie from London. I want to ask on that point there. We talk about growth trajectory of your business. I've been reading that the German energy and economic minister is currently preparing a report on German future electricity demand. Do you expect that to be as bullish as what you just said there in terms of demand for your products?
No, quite the opposite. I expect a report which will show that there will be higher electricity demand going forward. It's clear we are electrifying, but it will be lower than the projections that we have seen so far. There's a famous number, that's the monitoring, which I just mentioned on the political decision we're waiting for. We have currently a number of 750 terawatt hours of electricity demand in 2030 on the table. I expect the number to come out smaller, lower. Actually, however, to be very clear, that has a big impact on renewables. If we need less electricity, we need less renewables, that's clear, but it has basically no impact on infrastructure because first, we are in a catch-up mode, and second, for infrastructure, what matters is not the energy consumption, but the peak demand in the market. And the peak capacity is still increasing. We are seeing more megawatts. So in that sense, if we get a lower report by the minister, it will mean an adjustment which will make the energy transition more affordable, but it will not change the growth picture for E.ON.
And when it comes to that infrastructure fund that you spoke about by the German government, it seems a lot of that money is going into other industries, such as railway industries. Do you think E.ON is going to directly benefit from this infrastructure fund?
No, only indirectly. If economy is developing better, that's obviously also good for the infrastructure provider in the country. But to be very clear, I don't want subsidies from the state. I don't want money from an infrastructure fund. What I want is a regulation which allows me to earn the margin that I need to make the investments which the country needs. And so therefore, I'm not asking to get a piece of the cake from whatever billions the government is allocating. I am asking for a regulation which reflects the risks that we have to take and the investments that we have to make.
Leo, it's Kriti in London. On that note, when it comes to the regulation story, I mean, we've talked about some of the measures that have been put forward to the German government, arguably to the European Union as a whole. But walk us through the kind of timing on all of that. Investments, at least when it comes from E.ON, are expected to kick up between now to 2028, for example. That is a very long time frame. What is the lag time between getting some of those regulatory hurdles eliminated or at least softened for you and actually speeding up the investment process?
Yeah, so we operationally, we are in the position that we could ramp up at any time, basically at any time. If we get the clarity, the process is currently that we're in a consultation phase on the regulation. There is a time frame which has been communicated by the regulator. Until the end of the year, that should lead to most clarifications, which would then allow us to revise our plans going forward. And we have always communicated to the market that if there's a ramp up, possible, we could deliver against that ramp up starting already in this regulatory period in 2027-28. So we need 1 year of lead time to significantly ramp up versus what we are doing today. And that is actually, I think, pretty acceptable in an industry where we are talking always about timeframes of decades.
All right. Leo Birnbaum, CEO of E.ON, we thank you so much walking us through some of those earnings and investment plans and regulation plans as well. We thank you so much for your time this morning. Coming up on the program, we're going to get another earnings conversation. Nordic Semi, those shares are rallying in a big way, higher by about 12% this morning. Their results beating analyst estimates across the board. We're going to speak to the CEO next on this very program. Again, earnings season coming in thick and fast. In the meantime, the broader indices green on the screen across the board. We did see some weakness in the tech story yesterday as well. A little bit of a rebound this morning, but again, not to the same extent that we saw in yesterday's trade. The DAX is the notable outperformer, higher by 0.7%. We can thank SAP for that move. Stick with us. This is Bloomberg. Welcome back to the opening trade. About 30 minutes into today's session, green on the screen across the board. The outperformer is the DAX, higher by 0.7%. I think this is significant that we're seeing a rebound in this index. It's been under quite a bit of pressure, not just in the last 24 hours, but in the last couple of weeks as well. That defense unwind hasn't actually helped the index as a whole, despite being the outperformer of Europe for the first 6 months of the year. Today, momentarily coming back onto that track, Guy.
Volumes are quite light. We are mid-August. That is what you would expect. 100-day average well below that. A lot of members higher than lower. Certainly there's a bid back into this market today. In terms of the 52-week highs and lows, there aren't many lows. So let's talk about the highs. What kind of stocks are we seeing at 52-week highs today? PKO out of Poland. Ryanair, interestingly enough. It's really, look at what we saw yesterday, the CPI print in terms of aviation fares in the United States. That's really quite significant. This demand certainly here in Europe. Ryanair up 0.8%. And Bilfinger, in terms of the German construction story, again, just kind of moving forward and forward. That stock not up by much this morning, but kind of just incrementally inching higher and higher through these 52-week highs, Val.
Well, here's what else you need to know this morning. Yesterday's inline U.S. inflation report is bolstering the case for traders betting that the Fed will cut rates in September, with some seeing an increased possibility of an outsized reduction. Ukraine's president has reiterated that he won't cede the Donbas region to Russia and push for Kyiv to be included in talks as Trump and Putin prepare to meet on Friday. Vladimir Zelenskiy and European leaders are set to hold a call with U.S. leaders to discuss negotiations later today. And finally, Treasury Secretary Scott Bessent has dismissed the possibility that Chinese investments in the U.S. could be part of any trade pact. When asked if China would make similar billion-dollar pledges like Japan and the EU as part of their trade agreements, Bessent said critical industries needed to be, quote, reshored away from China. Kriti.
It's a fascinating one to talk about those comments because he's really saying China and the framework for China does not apply, doesn't follow the same kind of lead that you're seeing from Japan, Korea, Indonesia, even Mexico, arguably, again, on national security concerns. And this was such a sticking point when it came to the conversation between the United States and Japan specifically because of the whole Nippon Steel kind of investment, this idea of do you want that foreign direct investment and at what point is that a national security concern? And it works for everyone else but China.
It tells you where the mentality is around China. The China deal is different, and maybe that's why it's so much harder to reach in terms of the emphasis that is being placed on that. We've talked about the fact that all the trade deals are going to be done by October. That feels hard for the China deal. The China deal feels like it's going to remain not a deal, but a fluid situation that's going to kind of just continuously evolve.
For perhaps the next 3 years.
Without necessarily a clear end game in sight there.
And I think the Bessent comments might also show that instead of wanting some investment deal, what they really do want is these agricultural purchases. They want purchases of energy as well. We know that's something that's Trump brought up this week, the purchase of soybeans. So it just could mean that there are other priorities when it comes to the U.S.
But the Chinese are sending very
China.
different messages on that. They're building an energy infrastructure that is not based on the United States. They certainly don't want to harness their economy to that narrative. They're buying soybeans from Argentina, from other places. They're trying to move away from the U.S. agricultural story. It feels like that's what the U.S. wants, that's what the Chinese want. The Venn diagram overlap here is not that great.
So where they are diversifying, especially on agricultural products. Well, the one thing that is irreplaceable is the American consumer. There is no other one country that has that much kind of expenditure with China, and that's actually the concern on the American side as it is with the Chinese. And a good chunk of that ultimately is the tech story as well as it kind of feeds into the broader U.S. consumer and the broader kind of industrial build out there as well. There's one company in the tech space that we need to give some attention to this morning, and that is Nordic Semiconductor. Shares rallying this morning over in Oslo to the tune of 14%, a massive beat when it comes to their second quarter. I'm pleased to say we're joined this morning by the CEO, Vegard Wollan of Nordic Semiconductor. Vegard, a pleasure to have you on the program. Thank you so much for joining us. Just walk us through these numbers when it comes to what's driving this quarter.
Thanks a lot and good morning. Yes, we did see Q2 becoming a strong quarter for Nordic. It is happening as our products relatively mature, and our products actually at the moment are still competing extremely effectively in the markets we are participating, both with our larger customers and in the broad market. And this is for electronics connectivity products in the consumer segments and industrial healthcare, so broad markets. Geographically, we see that there isn't anything disruptive happening, but there is a gradual recovery happening in all geos and the markets we are participating in. As you know, we are a global leader of ultra-low power wireless solutions. And what's probably to add to that is that we have seen Asia and North America probably leading a little bit the gradual recovery from the semiconductor downturn in 23 and 24. We now do see some clear improvement also happening in Europe, which is very positive.
Vegard, I'm looking at some of your numbers here. Your revenue, massive beat. Gross margin, very, very big beat, in fact. But the capital expenditures is the number that sticks out to me here. I'm looking at $9 million. A year ago, that was $2.5 million. Your estimates from Wall Street coming in at $6.7 million. Can you just walk us through the confidence with which you're pushing and you're investing in terms of CapEx right now?
Yes, we are in the midst of a very large product portfolio renewal cycle, which we are really excited about within Nordic, which means, like in our core businesses in the short range segment, we are renewing our portfolio, which is actually back from 2015, 16 to 18 in the launches of what we currently have in production. We started in November last year launching what we call the 54 series, which is the start of a complete renewal of that. With that also comes the needs to update and optimize and further improve our manufacturing equipment and manufacturing capabilities as we are moving these products to high volume production with our supply chain partners. And the CapEx is a bit irregular from a quarter to quarter point of view. We do have our certain KPIs and investment levels we want to be at within a year. And we are well within that at the moment, but we do now see that in the second quarter, we did actually fairly large investments to support the production ramp coming for these new products in the coming quarters and throughout 2026.
Vegard, good morning. It's Guy. Are you being affected by tariffs?
So far, I think it's fair to say that we haven't seen any major impact, neither positively nor negatively. We can obviously not rule out that wouldn't affect us and impact us in the coming time. I think the overall semiconductor industry, it's clear that it's built on a very open economy and open trade over the last 20, 30 years. So there are changes happening to that. It is, though, a relatively even playing field. Many of us are using the same manufacturing partners, manufacturing countries are certainly concentrated around certain areas, certain countries. So it's a relatively even playing field from that point of view.
In terms of the trends that we're all watching at the moment, where do you think the big boost for Nordic will come in the future? Is it robotics? Is it the cell phone industry? Where do you see your next big market coming from in terms of how you are positioning this company? What is it that you think will be the big driver that takes Nordic forward from here?
Yeah, it's a great question, and I think how we look at it, and I'm quite happy with that answer. It isn't a single product and a single killer application which is requiring us to deliver on our fairly high growth ambitions, which I think you have noted. So we expect to see existing products being even more broadly adopted. The wireless connectivity megatrends just continuing in that space and within consumer electronics, certainly with some new products and some new elements happening there. If there is probably one area which still is of extremely high focus and interest for us, it is probably within the healthcare segment and the way that we see artificial intelligence, machine learning, and really high compute power happening in the edge device and locally in the healthcare type product. The drive and the execution and the new products that we may and very likely will see in the coming time in that space is really encouraging for us.
Vegard, are you looking at any potential acquisitions to grow your business? I see that earlier in the summer you acquired a U.S. startup based on cloud-based software. Is there any other pockets of potential M&A activity you're looking for?
Yeah, that's a good question. If you ask my HR team, they would say, please no more acquisitions throughout this year. we did actually announce two now about just over a month ago, two US company, a very small company, Newton AI, which is bringing us software in the edge AI space, extremely powerful but light-weighted solutions, targeted solutions exactly for the market we are participating in with edge node, high compute intensity. And as you said, we also acquired Memfault in the US, which is a cloud lifecycle management company. With that, we obviously need to consolidate and integrate and deliver with those two acquisitions we just made. But we have our radar active at all points in time. There isn't any strategically specifically missing at the moment, but we are actively and opportunistically looking at that all the time.
For other opportunities you might be looking at, you did mention that Asia as well as North of America, you saw some decent growth in. How are you viewing the broader risks of this trade deal that we were just speaking about between the U.S. and China having some impact on your business when it comes to China growth?
We actually see that. So we are not exporting lots of products directly into North America. We are typically with our customers and end customers for Nordic, which is we are in a B2B setting business-wise. We are obviously mostly shipping our products from our country of origin, where we are manufacturing, to their contract manufacturers and subcontractors. That is to some degree a landscape where we do see some customers actually executing change at the moment, but it isn't like you can do big changes, particularly not in semiconductor manufacturing, but neither in electronics device manufacturing in a heartbeat. These cycles and these changes do take some time, but we do see some gradual changes happening there, and we are closely supporting our customers and working with them as they may move from a manufacturing destination A to a manufacturing destination B. So that is a lot of our focus at the moment. We focus at what we can do something about relative to trade policies and tariffs, and that is truly to be strengthening and continuing building our resilient supply chain, as well as supporting our customers where they choose to manufacture.
Vegard, great to catch up. Really appreciate you running us through the numbers and the outlook from here. Vegard Wollan, the CEO of Nordic Semi, out with numbers today. Coming up, Volodymyr Zelenskiy will be in Berlin later today to take part in a video conference. The European leaders are going to be talking to Donald Trump, this ahead, of course, of the summit between Trump and Putin that is going to be taking place in Alaska this Friday. We'll talk about what's at stake next. This is Bloomberg. Welcome back. You're watching the opening trade. Volume is a little bit light, but equity markets are higher. Volatility is down. Equity markets are higher. As you can see, it's a pretty decent picture across Europe this morning. A little bit of a comeback in some of the tech stocks that got beaten up yesterday. Defence is also making a comeback, which kind of takes us on to what we're going to talk about next, and that is what is happening with the Ukrainian situation. Bloomberg has learned that Ukraine's Volodymyr Zelenskiy is going to be going to Berlin later today. He's going to be taking part there in a video conference, which is going to be including the President of the United States, Donald Trump. We think the VP is going to be there as well. European leaders are going to be on that call. This, of course, comes ahead of the Russia summit Friday, which is going to include the President of the United States and Vladimir Putin. Nobody else. Let's talk about what's at stake with the call today. We think it's at 2 p.m., 3 p.m. Berlin time. Greg Sullivan joins us on that to talk about it and the significance of Zelenskyy's comments about not ceding land in Donbas. Let's talk about that first of all. The land story, I think, is really interesting at the moment. Zelenskiy is saying this is a red line. How hard is that red line, do you think, on not ceding land?
these are very important comments from President Volodymyr Zelensky. As you said, he's not going to be at the table in Alaska. Neither will his European allies. So they're really trying to telegraph red lines. Now, this is not a new comment from Zelensky. He has been pretty clear that he's not willing to cede sovereignty or territory. He does not want to make concessions to the aggressor in this war. So he's really trying to lay out for Trump red lines. The worry being that President Trump will go meet President Putin. They'll agree to a deal that later Europe and Ukraine will say, no, we can't agree to this. And that raises a host of other questions about U.S. support going down the road, as well as U.S. engagement in NATO. So they are trying to avoid that worst case scenario.
Greg, European leaders and Vladimir Zelensky have said that they'd be willing to directly talk to Vladimir Putin and even take on some of the security guarantees that the U.S. has provided, given there is that American backstop. Do you think the narrative changes around land cessation if the U.S. provides those securities guarantees for years to come?
So that is a key question here. The security guarantees haven't really been coming up in conversations out of the White House ahead of this summit, but they are crucial to Ukraine in stopping this war. Ukraine has been very adamant that they need security guarantees. Otherwise, what's to prevent Russia from restarting the war down the road, especially if they do have this bridgehead in the east, which Zelensky noted they would use for further aggression down the road. So Ukraine has been focused on security guarantees. That's critical for Europe, but the U.S. has been reluctant to say that they would provide those security guarantees. So that is a key question in stopping this war, as much or more so than the land, which obviously Trump seems to think will resonate with Putin. So those will be key questions coming out of the talks, both with the European leaders and then later with Trump and Putin in Alaska.
Well, you just briefly spoke about that phone call that we are expecting between Europeans and Zelensky with President Trump going to be taking place this afternoon, London time. What do you think the main message from Europeans to Trump is going to be?
Well, there's two real things. First is that they want to telegraph red lines. They want to make sure that Trump understands what they can't agree to in a deal unless Trump makes that deal with Putin and then puts Europe and Ukraine in a very awkward position where they have to say, no, this is not acceptable, risking the ire of President Trump. So they want to make clear those red lines. They also want to send the message that there needs to be discussion of security guarantees for Ukraine. And they want increased pressure on Russia to stop the fighting. Europe has long said that they would like to see an unconditional ceasefire before the start of any real negotiations to end the war. So those are the key messages that they are trying to take to Trump, given that they are not at the table when the actual Alaska summit happens.
All right. Bloomberg's Greg Sullivan walking us through what we can expect from that conversation today. We thank you so much. We should also mention there's another big conversation happening between two leaders. According to the FT, U.S. Vice President J.D. Vance is planning to meet with Reform UK leader Nigel Farage. Now, this is interesting. We had a conversation this morning about what a working holiday is, because J.D. Vance is supposed to be in the Cotswolds having a nice time, but he's meeting with leaders across the board.
You're either working or you're on holiday. It's kind of the way it goes.
Either or.
Maybe J.D. Vance is changing changing that European culture one meeting at a time.
Well, I mean, maybe to that point, he at least the Times was reporting that he did try to schedule a meeting with Kemi Badenoch, but their schedules did not align. Maybe she is on holiday and is not working that holiday.
that would do it. I think what stood out to me, though, is the fact that he is at the end of the day meeting with Nigel Farage, and this goes into a conversation, and then we kind of knew that from a political standpoint they may be aligned, but the fact that he is meeting with other parties, other leaders in the UK, given that the legal battle between the Starmer administration and Donald Trump is ongoing. Donald Trump sued Starmer for backing or kind of door knocking.
Do you know? It feels like there's a bit of a loving going on between the White House and the UK at the moment. You've just seen Trump coming and to his golf course.
Sure.
Very happy. You've got the Vice President holidaying in the Cotswolds. The UK got a deal early on. In terms of where the relationship is least fraught, it does feel as if the relationship between the UK and the United States is probably where it is least fraught at the moment. How does that show up in reality and kind of action on the ground? I don't know. Maybe the UK economy is better positioned as a result of all of this. It's hard to see that, certainly in the data that we are getting at the moment. But I think it's it is going to be interesting to see whether this is a longer-term story, whether this... Because the details have still got to be worked out in terms of the trade deal that is happening here. They've got to be worked out with everybody, but they've still got to be worked out largely with the UK. So, I don't know. It doesn't feel as if the Biden administration felt a little bit more hostile to the UK. The Trump administration feels less hostile towards the UK.
Yeah, and I think it's just putting Reform UK even more on the global political map. J.D. Vance is obviously taking their chances at political power seriously. Maybe that's why they're having this meeting.
Does that work against you, though? Does that work against you or for you? I don't know. That's the hard thing. How is Trump perceived in this country? Is he perceived as a positive or a negative? Therefore, it could be taken either way from a political point of view here in the UK.
You know, a lot of things to monitor today. We also have some data points to monitor. None of them are very big ones, I have to caveat with. But later today at noon, we have U.S. mortgage applications. Later at 3:30, we also have oil inventories. And then later in the evening, we have the Bank of Canada summary of deliberations from their previous meeting. We also get another round of Fed speak, which I think this will be quite interesting. We want to hear from them what they still think about those payroll revisions from a few weeks ago and what was their reading on U.S. CPI. We did hear from some Fed members yesterday. Schmid saying tariffs seem to be having a limited impact on inflation. That was also commented on by Barkin. We spoke to the Wall Street Journal saying inflation will be more moderate than people think. So it does seem to be like there is a dovish tilt to Fed members in their speech.
Well, they're all job interviews, aren't they? Every speech now is a job interview, listened to by the White House. Everybody's on the list. Who wants to be the next Fed chair?
I mean, they're even getting pressure from the Treasury Secretary, who is... arguably in charge of these interviews for Fed chair, calling for the Fed to be considering a 50 basis point rate reduction in September.
You ask that question to a Treasury Secretary in the past, they go, monetary policy,
commenting.
Nothing to do with me. Nothing to do with me. Go and talk to the Fed chair.
It's a new world, Guy.
I'm very aware of that. But it does seem as if... I think in some ways it's genius. Like, tactically genius. Put everybody in the list, make everybody... kind of go through that hoop and see what the result is. Maybe at the end of it, you result in a 50.
Is all this talk, though, of 50 or potential cuts, all this political pressure, doing the job that they want anyway? Like, is the effect of the 50 already showing up in these markets?
Well, we'll see in the September meeting, right? I mean, if it has more dissenters. I mean, Powell had 2 dissenters at the last meeting. If you have 3 or 4 coming from Fed governors, you really start to doubt the Fed chair's position.
But if you want 25, you ask for 50, right? Isn't that the Trump way?
Yeah. He should have said 75, right?
Go big and then basically
hit 100
pull it back.
to get to 50.
Yeah.
I mean, but at the end of the day, when it comes to things like financial conditions, for example, the stock market, as we've highlighted multiple times, it's on a roll. Credit spreads are on a roll. The dollar's weakening, yes, but it's coming back as well. Isn't everything fine for the U.S. economy at the moment?
That is what the vol markets are telling us. We have the VIX at year-to-date lows. Vol declined across assets yesterday. For the markets, the big takeaway is that the tariff impact on inflation is minimal, and we're moving on.
Yep, nothing to see here. Never going to happen. Might show up a little bit later, but we'll worry about it then. Anyway, don't miss our interview with the Treasury Secretary. He is going to be joining Bloomberg Television a little bit later on. Scott Bessent joining the surveillance team later today at 12:30 p.m. UK time, so just after noon. So we're looking forward to exactly what he has to say on that interview process and those 50 basis points that he would like to see. All of that coming up. The Pulse is next, though. Francine Lacroix in the chair. This is Bloomberg.